Let me welcome on board Sandip Agarwal as well from Sowilo and talk about what he's making of the market right now. Sandeep, hi, afternoon. Some amount of respite. Can't say that one is out of the woods, but what is your own sense on whether we've declined enough to start, adding to positions perhaps across the board?
Yeah, hi, good afternoon, and thanks for having me on the show. So yes, as you rightly said, there is a lot of volatility still, and we cannot say that, things are settled. But definitely, valuation comfort is much, much higher, and RBI is consistently pushing in some liquidity. Also, X of crude, we don't see there could be a very big jump in inflation numbers. So I think, this is the right time for long-term investor to start looking at market, and valuation comfort is very high. Also, it is much better than earlier in terms in mid cap and small caps also. And across sectors, I think barring one or two sectors, most of the sectors have also come down to a very, very reasonable range. So I would say, yeah, it is time to start buying. And, obviously, you cannot call out global events, what can unfold. But other than that, things look good on the local front.
Right. Okay. So, Sandeep, I guess the next question is what's looking attractive after the recent bout of decline in the market?
So now we are very constructive on one sector which we were not at all investing for last 14-15 months is IT. I am looking very positively after a very long time on the tech side. I think most of the stocks have come down into very reasonable range, excluding the ER&D place. So this one sector looks very, very attractive right now. Other than that, obviously the private sector banks are continue to look good. And the manufacturing, I think last 1.5 year manufacturing was very slow. Now we are seeing green shoots of those picking up. So the whole space, right from cable, wires, transformers, which also are ecosystem play for the AI thing. Other than that, the core capex companies, industrial goods, all those things are also looking very good. So we are very, very positively looking at, cap goods once again after a long pause, some of the other manufacturing names. And along with that, obviously the tech platforms, which remains our favorite, and now incrementally software services and private banks. So this is the way we are looking at. We are still in a little avoid mode on the OMC side and the oil and gas side, and also on the FMCG side. But we are constructive on rest of the sectors because everywhere there is a meaningful correction. Yes, we are also not looking at auto right now because we believe that a lot of money has been made in auto. So we will be a little more cautious from here on the auto space also.
Sandeep, I almost was hearing you in disbelief. Is that really a call change on IT? Because you've been bearish for quite some time. And again, the question is it just a tactical move or rather tactical call because the sector is so oversold? Or do you fundamentally believe things are changing?
No, so, I never had a view, and I always believe that our business is very sticky. We are software factory of the world. So I don't have any doubt on the business model and all. Only thing was that this time the business model has got hit on the effort side because of AI 20-25% decline in efforts was to happen. Since contracts are for 5 years, every year 3-4% of deflation is there. So you have to grow at 8-9% to post a 5% growth also. And now with rupee at 92, you get 3-4% benefit on the PAT because of currency. So 8-9% profit growth and 15-16 times large cap, I think it is a very comfortable thing to do because of good corporate governance, good board, and good visibility. But I was uncomfortable earlier because the peg ratios, the currency was also at 86, 87, and the growth was almost looking like zero. So then, at that price at 0%, growth in profitability, you can't give a 25, 28 multiple. So peg ratio was looking very insanely high. Now peg ratios are looking very comfortable. Although still we are not comfortable in the names in ER&D because there the peg ratios are still 4 times, 3.5 times, which we are not comfortable. We are comfortable up to 1.8, 1.9 time peg ratio, which is there in the few of the large cap IT names and some of the good quality, big size IT services firms in the mid cap space and some of the small cap names. But we are still finding the ER&D space to be very, very expensive.
Okay, very interesting analysis there on IT. But the banking pack is under pressure, or rather has continued to be so, with the Nifty Bank logging its second biggest intraday fall as of yesterday. There have been concerns, of course, about over-leveraging in the MFI space and sluggish NIMs, which are adding to the caution. The big question, of course, is whether this is a warning sign for the sector or a buying opportunity for investors. Snehi is here with some analysis.
Well, yes, so the Nifty bank sector has been in focus ever since the markets have taken a tumble on the back of everything that's happening geopolitically. But if you've noticed carefully, the quantum of the fall or the volatility that we're seeing in the Nifty bank index has on most days been higher than the fall that we're seeing in Nifty. So yes, while the market sentiment is negative, has been so far other than today and has been getting to this entire basket of stocks, there are some fundamental reasons within the banking space itself that is leading to this fall. So what is the fall? First, let's understand that Nifty Bank has reported its second biggest fall since COVID days all the way back in 2020. In the last 1 week, the index is lower by about 5%. Last 1 month, a 7.5% cut. On a year-to-date basis itself, the index is lower by 6.25%. So let's understand what are some fundamental factors that are ailing the sector. First, there is over-leveraging. That remains a structural risk in the microfinance sector due to multiple lenders financing the same borrower. This is a risk that is ailing the sector, one of them. Second one is high borrower leverage is weakening repayment behavior, and this increases credit stress in the system. So this is also yet another negative. And also the measures to curb multiple lending aim to maintain credit discipline and improve long-term asset quality across the microfinance institutions ecosystem. So unless this happens, some of this stress is expected to stay. Let's understand what the stock returns has been on an individual basis of some of these constituents. From the private banks, Kotak Mahindra Bank has seen a cut of about 6.5%, but the big loser has been ICICI Bank, about a 7.25% cut over there. From the PSUs in the last 1 week, you've seen some big cuts coming in on SBI, Bank of Baroda, Union Bank, Bank of Maharashtra took quite a cut yesterday as well. So that was something to watch out for. On a 1 month basis also, about a 10% cut coming in on both HDFC Bank and Kotak Mahindra Bank, some of the top contributors to the Nifty and the Nifty banking index. If you take a look at what the valuations look like on a price to book basis, Kotak Mahindra Bank currently trades at 2.3 times. The 5-year average is 3.4 times. What I'm trying to say from this graphic is, if you take a look at the price to book of these companies right now compared to their 5-year averages, all of them are trading lower than the average, and this is the indication of the stress that lies in the sector. And these are all the names that we've been tracking: Axis, ICICI, HDFC Bank, IndusInd and State Bank of India. The biggest variation, in fact, coming in on Kotak Mahindra Bank, 3.4 times is the 5-year average. It's trading at 2.3 times right now. So that's the reason, on some of the reasons why the banking space has not been doing well, and the kind of impact that we've been seeing on some of these stocks, both from the private and PSU baskets.
Okay, thank you so much for that, Snehi. Now, quickly, we also spoke with Digant Haria, co-founder GreenEdge Wealth, and he sees the top private sector banks growing in the 12 to 25% kind of mark over the next 18 months. That's kind of returns he's penciling in. Let me make that clear. He also sees top companies within microfinance and small finance banks rather should do better, and there should be some outperformance there. Listen into his views.
Kotak, ICICI, HDFC, all of these banks look ripe for, 15, 20, 25% kind of rallies over next, 18 months kind of a thing. So, a regional bank, something like, say, a Tamil Nadu Mercantile Bank or a DCB or even South Indian Bank, a lot of these banks will deliver good numbers, good ROEs. So I think they can outperform the general banking sector. So microfinance / micro lending as a space should do well. There are a lot of small finance banks, a lot of microfinance companies there. The top names typically should do very well there.
Okay, that's that on banks. But let me also welcome on board Nagraj Shetty and find out what he's observing on the charts right now. Nagraj, hi, afternoon. Good to have you on the show. What is this rebound of 250 points telling you? And does it look sustainable to begin with?
Hi, good afternoon. Market is showing much awaited bounce back from the lower levels. I think seems to have formed a short-term bottom reversal around 23,700 levels. But interestingly, if you look at the chart over the last 1 month price action, what we can observe is the lower tops and bottoms. And even after 2 to 3 days of bounce back, market eventually turned down so far from the lower highs. And most of the opening downside gaps are remains unfilled and partially filled. Some of them have filled, but eventually market has turned down after the filling the gap. So these are all indicating that we are not still out of woods. I think there is a higher possibility that 24,400, 500 is going to be a strong resistance for the market. And there is a higher possibility that I'm expecting Nifty to come down again from near the resistance. So I think this is going to be a sell on rise opportunity.
Right. And within banks then, Nagaraj, is it looking like it's going to be a sustainable move? And then again, how do you approach PSBs versus private banks?
I don't think Bank Nifty itself has bottomed out in big up move is likely. I don't think so at this point of time. We need more confirmation on the bottom reversal. I think this is just a bounce back of a downtrend, and around 57,600, 700 levels, the whole host of resistance could come in around 200 EMA, previous swing highs, swing lows as per change in polarity. So many resistance is placed around 57,600, 700 levels. I think from there, Bank Nifty could turn around, could come down from the higher levels by showing a sell on rise opportunity at this point of time.
Okay. And so a sell on rise is what you're building in, especially on the Bank Nifty. Would you be more constructive PSUs, Nagaraj, versus private sector? Is there a tilt that you have there?
I think PSU Bank is looking positive compared to the private banks. We have seen some good strength in the PSU banking charts recently, especially Canara Bank, Union Bank, State Bank of India. They have constructed very well from the lower levels. They have seen some good momentum on the upper side. So I think compared to private banks, I'm betting more on the PSU banking stocks. Whenever the Bank Nifty recovers, shows some significant upmost from the lower levels or forms some bottom reversal, I think the PSU banking sector is the one could lead the index in the near future.
Sandeep, do you have a preference, a tilt, whether private sector, PSU banks at this juncture? What's the view?
No, I think that the PSU banks are posting very good numbers, and there is a good runway from here also. But given the way valuations have gone up a little bit for PSU and the way it has come back for private banks, as you also showed in the table, I think now there is the incremental reward for only being in PSU bank is receding. So we are also looking at private banks now. I think all these private banks are come to very good valuation, and from here good return should be expected in them as well.
Okay, interesting. I'll switch focus to the fertilizer space, and some of those stocks seeing some rebound after the government assured farmers that inventory remains adequate for the upcoming Kharif season. Meryl here with the details on that one.
Well, yes, the fertilizer segment has recovered quite well from yesterday's tremendous decline after the Fertilizer Association of India has said that supplies of urea as well as phosphatic fertilizers will remain sufficient in order to meet the agricultural demand for the next Kharif sowing cycle. Well, actually, official data as of March 6th also suggests that total fertilizer reserve stands at 177 lakh tons, which is around 36% higher on a year-on-year basis. Government is also rolling out an optimization plan in order to ensure that essential sectors such as agriculture are not impacted by the LNG crunch from the West Asia turmoil. This includes a scheduled maintenance at fertilizer plants where demand is currently low, so that the production capacity is fully available when the Kharif demand starts to pick up. In order to address concerns around gas supply, India is also diversifying their LNG sourcing, with around 60% of LNG already coming in from outside of West Asia, with countries like Australia and Canada now being explored for additional supply. Now, following these reassurances, we've seen fertilizer stocks that had fallen in trade yesterday around 2 to 6% lower have now picked up quite a lot, especially in the private sector fertilizer space. We've got FACT leading the pack, and also Rashtriya Chemicals, National Fertilizers, Gujarat State Fertilizers, Chambal Fertilizers, and many others following up around 2 to the range of 12% in today's trade.
Right, and that's the fertilizer pack, and it's holding out quite smartly in trade. In fact, Kunal, any trade that you're spotting, given how big the move is in the entire fertilizer pack?
Yeah, I think there are a few names. For example, RCF is something which has moved up 17-18%. Of course, to give a buy at current levels is not something which I would do at current zone. But I think the chart setups for these stocks are looking a lot more better, because over the last 1.5 years, these stocks have been consistently falling, and falling by a margin of 10-15% in a matter of weeks, or sometimes in a matter of a couple of months. So at least this rise for the stock prices arrests the kind of sell-off which these stocks have shown. Chambal Fertilizer I think is the other name the stock has. seen a huge sell-off. I remember, I think 2024, the stock was around the 650, 700 plus kind of a zone, and it's moved, sub the 400 levels. Very recently, it's managed to make a comeback about the 400 mark. So that's another name to look out for. So I believe that there are many of the interesting names which are looking better. The beta of the sector is a little bit more on the higher side. So I think if I have to pick and choose, I would probably go with Coromandel as well as RCF from the pack.
Okay, Coromandel, RCF, given that some of the other names have already spurt up quite a fair bit. But in an exclusive chat with ET, my colleague Ankur Mishra caught up with Moody's and ICRA to try and understand about the health of the financial sector and, of course, growth targets for the same as well. Here are an excerpt.
For the NBFC sector, the conventional asset segments like the home loans and the vehicle, these two segments together account for almost 44-45% of the overall book. They will grow at a stable pace of about 14-15%. The driver will not be one segment unlike what we saw this year and maybe the previous year. It will be all segments will operate in a very, very narrow range in terms of growth over the next financial year. Most of them will be in the, if I have to put it a broader range, it will be somewhere close to about 15 to 20%. The larger asset segments will operate in the 15% range. Segments like LAP will grow possibly at a higher rate, about 20-odd%. But the other key segments will all grow in that 14-15% range, which will result in a broader, average of about 17-18%. The unsecured segment, it's saw very strong growth coming out of COVID. It has moderated from those levels of what we saw, maybe a 40% growth in the consumer finance and personal loan, etc. In 2023, 2024, it has come down to 24%. It's in the current financial year. We would see that also to grow at close to about 18-20%. So if I have to categorize these broad asset segments, the secured, conventional asset segments will be growing at about 14, 15, 16%. LAP, personal loans, these are the segments which will grow at about 18 to 20%. So the broader weighted average number would be somewhere close to about 17% for the next financial year.
Right. Mr. Pandey, you expect low to mid-teen growth for banking loans in FY 26-27. Where do you see it will come from? It will be more of a retail credit, or you think that there is going to be corporate capex revival next year?
So we continue to expect higher credit growth in the retail segments and SME, and followed by the corporate. We do think that the capex is running at a healthy clip in India, and that's why the GDP is growing at a certain level. But we don't see any divergent in terms of a rise in capex from these levels. And we should also notice that the avenues that the corporates have to finance the capex have changed in India. A lot of them are financing through their internal accruals, bond market, equity markets, and external borrowings as well.
And just to kind of quickly switch focus, Dixon Tech, oh my God, the move there has been extremely solid. You're seeing a 11.5% move on that one now after the Ministry of Electronics and Information Technology approved the joint venture between Dixon Tech and HKC Overseas, which will be operated through Dixon's subsidiary, which is Dixon Display Technologies. Srishti here with more details on that one.
Well, yes, the final approval is through with respect to the JV with HKC Overseas of Dixon Technologies, and this was announced back in June 2024, wherein Dixon Tech was supposed to have almost 74% stake in the combined entity, while HKC Overseas, which is a Chinese company, will be holding 26% of the stake. And back then also there was so much of analysis with respect to how this will help Dixon Tech to actually go ahead and have these LCD modules at play. This will help them to have a better backward integration and also help their margins to expand, because the LCD modules will not just have an applicability or application with respect to the mobile phones, but along with that other sectors will also be a key beneficiary, or Dixon Tech can supply to other sectors and companies as well. And HKC being a global company, they also have a very strong clientele.
Nomura has actually come out with a note as well, wherein they maintain a buy rating on Dixon Tech with a target price of 14,678 rupees apiece, where they say that the approval gives clarity on the JV ramp up. The plant's trial likely to start in the second quarter of FY27, and ramp up is expected in the second half of the same fiscal. The company has already announced their 12,000 crores of investment plan, and add to that, this could add 50 basis points of margins by FY28, because this will lead to a backward integration. So that's the take coming in on Dixon Tech, and the stock is also excited in trade. Okay, there's that on Dixon, and of course the stock is holding out very well. Sandip, curious to know, what is it that you're liking within EMS players now?
So we still think that the EMS space is little expensive. We are not looking at any stock within the EMS space. We will wait for some correction, because we believe that the valuation which are there, they don't take into account any kind of, they're priced to perfection, and they don't account for any kind of miss. And when that happens, then the falls are very sharp. So, they have come down meaningfully, like Dixon, PGL, they have come down meaningfully. But still, we will wait for them to be more comfortable range of valuation, which prices in some kind of uncertainty also.
Okay, interesting. What about some of the wires and cables stocks, Sandeep? Do you have a view there?
Positive. So because we want to play the whole ancillary chain of the power sector. So wire and cable and transformers space, we like the space, but we are not looking at the large names, because they are super expensive. We are more keen on the very small names, unknown kind of names, where the growth could be better and the multiples are very, very low. So we are more keen on the small and mid cap space in the wire and cable space.
Okay. Nagaraj, do you have a view? Polycab, KEI, the kind of moves that we've seen, they've taken knocks in trade, huge ones, 6% odd. Opportunity, you reckon?
I don't think so. Initially, after the long time, they have started. In fact, Polycab has started declining from the higher levels. I think some more weakness is likely towards 7,400, 7,350. And after that, there is a higher possibility of a bounce back from the lower levels.
Okay, just marking some of the other movers today, and of course, while Polycab has fallen about 6.25%. Today, it's the technology names which are also taking a little bit of a breather. Look at a Coforge, which is down 2.5%, Infosys, TCS as well, which are lower. And then Reliance, after, taking the Nifty all the way up to 24,000. Today, it's quietened down and it's down about 1% as we speak right now. Unilever, ONGC, Adani Ports, Sun Pharma are some of the other names which are also sort of ebbing off. Sandeep, there is heightened activity or excitement around the pharma universe, especially because of the GLP-1 generics hitting the market month end. What is it that you're liking within pharma, if at all?
So in pharma, we have changed our choice again from CDMO to now generic pharma and the big pharma names, because there is a lot of value there. So the large pharma names in the generic branded space are the ones which we prefer. We are not going into the branded space, the CDMO space, because CDMO I think is very, very expensive right now. So we have changed our targets into the generic branded pharma space, and we believe that there is a lot of value in that space if we take a 2 to 3 year call.
Okay, all right. Kunal, anything within pharma that looks interesting? I know you spoke today morning that pharma has been their outperformer and could continue to do so. Any preferences within that pack?
So yeah, I think Sun Pharma starts to look attractive at current juncture. The stock, I think at 1820 levels, I think something which I would probably peg for a big breakout. And by that I mean potential for the stock to try and even scale past about the life highs previously made. I think just about that 2,000 odd levels for Sun Pharma and beyond that. So I believe that that's a stock which is due for a turnaround of sorts. Lupin is the one which has been doing fairly well. That continues to look attractive. Dr. Reddy from the pharma pack has started to show signs of a breakout just around the 1300 levels. From the emerging slight high beta stocks in the pharma pack, I think Aurobindo Pharma has been doing very well for itself. It's come out of a massive rounding bottom formation on the weekly charts and spread over the last, I think, 6 or 8 weeks for the stock price. So that looks attractive for potentially another 100 points to 150 points on the upside with the near term. So the option gets a lot more better from the pharma sectors. You can choose the kind of beta which suits your risk appetite, and I believe that there are opportunities available from this pack.
Okay, that's the take coming in on pharma and what Kunal is finding interesting there. Autos, of course, as the trend is seeing a big move today. Some of the private banks are holding out well. And then, of course, there is that entire PSC trade, which is also looking good. Sandeep, X of banks within PSUs, what is it that you're liking at this level?
No, so, PSU banks, we like almost the large names a lot because, they have been delivering consistently. Good names, but we are not liking so much of the, power finances and others. We are more keen on the pure banks, and they are also the large names because, we believe that the numbers will continue to be good. The credit cost will remain muted. So that is our preference. But as I said, that from a only PSU bank liking to now, we are more also looking at the private sector banks because we believe the valuations have corrected quite meaningfully.
Okay, the private sector banks as well attractive after the recent correction. But Nagraj, what is your own sense? Anything within defense that you're liking or you think it's run up too much?
I think from the defense pack, whole defense sector is placed at the crucial resistance. I'm expecting further upside momentum in defense sector as well as the prominent stocks. If you take Astra Micro, the chartically has been in a constant up move. Currently placed at the consolidation, we have seen a minor down decline in the last session and bounce back today, placed at the edge of a breakout of around 1050 levels, and even Majgaon GRSC also. So I'm betting bullishness on the defense stocks for the near term.
Interesting. Okay. Sandeep, your view with regard to defense?
For defense, we have been abstaining from investing because it doesn't suit our value philosophy of the fund. So we are not looking at any name in defense at these valuations. We believe that, the risk returns are not so favorable, although, it is a monopoly kind of sector and the demand is going to go up with the current geopolitical situation and all. But again, we believe that there has to be a valuation justification. We believe that the valuation justification is not there in the space.
And Nagaraj, if I can come back to you with regard to auto, some of the auto counters doing very well. I did take Kunal's view earlier, but what's the view there? Tata Motors PV up 4%, Eicher up nearly 4%, M&M, even the likes of a Maruti doing very well for itself, 2.5%+ higher. How is this entire pack looking?
Yeah, they have declined sharply. Auto sector has declined sharply during recent correction. And this is just a bounce back. I'm not expecting any bigger turnaround story from here onwards, especially in chartically. And I'm expecting this just a bounce back, and I'm not expecting a bigger up move from here onwards. We could see some selling pressure in automobile sectors from the high levels.
Okay, 4.5 minutes left to go before we wind up for the day. And today, of course, fortunately, it's turning out to be a decent day. The recovery or the rebound, of course, is playing out throughout the globe. It's not just us. Look at the Nasdaq futures. They've climbed up almost about 0.5%. S&P futures higher by about 25 points. And now you're scaling higher by over 200 points on the Dow futures as well. Asia, of course, has had a good close. And the European markets as well are building on to their opening gains. The FTSE MIB is now higher by 3%, and Stock 600, the broader markets that is, or the indexes are holding up well. Another 2.5% of an uptick coming in there as well. So across the board, good gains is what you're seeing. For us, of course, we've managed to eke out about 1.25% or so, equating to about an over 200-point move on the index, actually almost touching a 300-point move right now. 24,400 at least is back on the futures. But Nagraj, given today's move, where do you think we're positioned right now going into trade tomorrow?
Yeah, we can create a long position at this point of time because market remains strong for the day. And overall chart pattern is indicating that I'm not expecting a bigger up move from here onwards. I don't think this has a important trend reversal on the upper side. So there may be some more upside for next 1 or 2 days. I think I'm going to watchful around 24,400, 500 levels to be breakout. If that Nifty sustains above that levels, then one can accept that this is going to be a good reversal on the upper side and more upside would likely. Till then, I'm just going to be a wait and watch with the positive bias.
Interesting. Okay. So that's broadly the play. Curious to know, Sandip, what's the view with regard to the metals pack?
Again, metal, I think we are now in the late stage of the trade. They have done phenomenally well in last 1 year. And now we don't foresee much return from here. And even if there is return, see, this is a sector which cannot be a big weight in your sector. So we try to play them through quasi plays like pipes and related products. We don't prefer to play directly through the metal because it's too risky and very volatile for the nature of the industry it is. And we avoid generally in our fund direct plays.
If we let you guys go on that note, let's begin winding up for the day. And good amount of respite is what you've seen on the screens today. Whether it's out of the woods or not, that let's see what kind of handover we wake up to tomorrow.